Welcome to the Accounting Trio. Get ready for a journey through IAS 16, Property, Plant, and Equipment, where ancient logistics meet future logic, and one CFO tries to keep his sanity. An asset is not defined by its price, but by the future economic benefits it promises to deliver. Buying expensive equipment does not automatically create it. Sometimes it just creates an expensive mistake.
Sam, I have conquered the neighboring office suite. I shall record the desks and chairs as spoils of war at the value of the blood spilled to get them.
Negative. According to my probability matrix, those chairs have a 14.22% chance of structural failure within 6 months. I have recorded them as probabilistic debris with a value of 0.
Gentlemen, please. Under IAS 16, we recognize an item as an asset only if it is probable that future economic benefits will flow to us, and the cost can be measured reliably. Marcus, no spoils of war. Rob, it's not debris, it's equipment.
So, if I cannot hit someone with it to gain gold, it is not an asset?
Not exactly. If it helps us generate revenue over more than one period, it's an asset.
I am updating the ledger to include the oxygen molecules in the room. They are essential for your biological functions. Processing.
Rob, materiality is the thing. We are not depreciating air.
I have calculated the initial cost of our new server. I included the electricity used by the delivery truck's headlights and the caloric burn of the man who signed the clipboard. Total cost is $12,401.0032.
Absurd! I only count the gold I handed to the merchant. The cost is the weight of the coins. Why account for the path taken to get here?
You are both off. IAS 16 says the initial cost includes the purchase price plus any cost directly attributable to bringing the asset to the location and condition necessary for it to operate.
So, the cost of the slaves who hauled the stone to the temple?
We call them contractors now, Marcus. And yes, their labor is capitalized. But Rob, we don't count the truck's headlights, only direct costs.
My logic is wounded. Does directly include the emotional labor of the CFO?
Especially not that, Rob. Especially not that.
Hello everyone. Next, we discuss about depreciation and subsequent expenditure on capital assets. Depreciation proves that assets don't complain about aging, accountants do it for them. Fixing a machine keeps it running. Upgrading it makes finance teams argue about capitalization.
My marble pillars are eternal. To suggest they lose value is an insult to Rome. I shall record them at full value until the sun consumes the earth.
Incorrect. I have calculated the atomic decay of the server chassis. It is losing value at a rate of 0.0001% per nanosecond. I am updating the ledger every heartbeat.
Stop. Depreciation is simply the systematic allocation of the depreciable amount over the asset's useful life. Marcus, even marble wears down. Rob, we don't update per nanosecond. We do it periodically.
So, my fortress is dying?
It's expensing, Marcus. It reflects how we use up the economic heart of the asset. It's not about the death of the stone. It's about the matching principle.
I find useful life to be an insult to my immortality.
Sam, I have painted a mural of my face on the side of the warehouse. It cost 50 gold pieces. This makes the building more glorious. I am adding it to the asset value.
I have replaced a single screw in the server rack. It is a superior screw. I have created a new asset subledger, screw 01 version B.
No to both. IAS 16 distinguishes between repairs and enhancements. Marcus, your mural is just maintenance. It does not increase the asset's capacity. Rob, replacing a screw is a repair. We only capitalize if it improves the asset's performance or extends its life.
My face does not improve the performance of a warehouse?
Unless the warehouse is in the business of scaring away intruders. No, it's an expense, Marcus. Straight to the profit and loss.
Next topics are revaluation and derecognition. IAS 16 allows assets to reflect current reality, not just historical cost frozen in time. Revaluation is accounting's way of updating an asset's market selfie. Every asset eventually reaches its final chapter. Derecognition ensures the story ends transparently. It is accounting's version of saying, "Thank you for your service. Goodbye."
The market value of our office has increased by 4.5%. I have automatically sold the building in my simulation to realize the gain and then rebought it.
Why look at the market? The market is fickle, like a senator. The building is worth what I can defend with a sword.
We have a choice, the cost model or the revaluation model. If we revalue, we must do it regularly and for the entire class of assets. And Rob, you don't sell it in a simulation. You credit a revaluation surplus in equity.
Equity. That is a non-logical human construct for hope.
I prefer the sword method. It is more stable than your equity.
Just keep the surplus in the OCI and put the sword away, Marcus.
The break room toaster has ceased to function. I have given it a Viking funeral in the parking lot. It is now fire.
I have calculated that the toaster still contains 4 grams of salvageable copper. I will keep it on the books as toaster fragment alpha until the year 2045.
It's called derecognition. When an asset is disposed of for no future economic benefits are expected, we take it off the books. We calculate the gain or loss by comparing the net disposal proceeds with the carrying amount.
There are no proceeds, only ash.
I am still calculating the value of the ash.
It's a loss, guys. A total loss. Much like this conversation. Close the books.